I would flag one item inside that horizontal category because I believe it's more consequential than the current classification suggests. Our media and technology exposure with content provenance, C2PA compliance, and AI agent authentication is one of the more underappreciated, potentially category-defining opportunities we are watching closely. As the AI Act enforcement matures in Europe and globally, and as agent-to-agent authentication becomes a genuine infrastructure requirement and critical risk, we believe Digimarc's role could become a much larger part of the story. We are not resourcing it as a primary vertical today, and I want to be disciplined about that. But I would not want this call to end without analysts understanding that we see it and that our platform and roadmap already positions us for it without requiring separate investment to own that category as the market quickly evolves. Thank you for giving me this time to speak with you, and I look forward to updating you all as our exciting story continues to progress. I'll now hand it over to Charles to go through our financial results.
Thank you, Paul. Earlier, Paul highlighted several important developments related to our secure gift card solution, and I'd like to provide some additional detail before I cover Q2 financial results. We are pleased to see continued momentum among retailers. 2 additional retailers have committed to deploying our secure gift card solution across their stores, with one rolling out beginning later this month and the other scheduled for October. We've also made progress with the large retailer that postponed its pilot earlier in the year due to software availability constraints. The retailer is now planning to launch a pilot in September at a smaller scale than originally contemplated, with the objective of supporting a broader deployment beginning in the first quarter of 2027. Additionally, several other retailers are actively planning to start rolling out our solution in the first half of 2027. We are also continuing to see increasing interest from major brands that are exploring opportunities to enable their gift card programs with our solution. As these deployments expand, we look forward to demonstrating the effectiveness and scalability of our solution across a broader set of retail environments. These initial implementations are an important step toward broader industry adoption and over time position us to participate in what we believe is a significant market opportunity. Ending ARR was $11.6 million at the end of Q2 compared to $15.9 million a year ago. The change primarily reflects 2 previously disclosed events: the expiration of a $3.1 million contract in October 2025 and a $2.6 million contract reduction in June 2026, partially offset by net ARR growth of $1.5 million. As a reminder, the contract reduction related to 2 projects that were canceled following changes in requirements imposed by the government and customer. We are working with our direct customer to restructure the agreement and pursue the recertification of 3 legacy projects and the certification of 2 new projects. If successful, these efforts could, at a minimum, restore a meaningful portion of the lost ARR and potentially grow ARR much higher. However, the timing and outcome of these efforts remain uncertain. Based on the magnitude of the contract reduction, the absence of a committed upsell from this customer at this time, and the limited time remaining in 2026, we no longer expect to achieve our original target for significant ARR growth by year-end. That said, our confidence in the underlying opportunities remain unchanged. The anticipated ARR growth from gift cards has largely been deferred due to timing related to the alignment with our go-to-market partners, a process that has now been completed. As a result, while the timing has shifted a few quarters, we continue to expect meaningful ARR growth as this initiative moves forward. Total revenue for Q2 was $7.4 million compared to $8 million in Q2 last year. Subscription revenue, which accounted for 51% of total revenue for the quarter, decreased $900,000 from $4.6 million to $3.7 million. The customer contract that expired in October 2025 accounted for substantially all the change. Service revenue increased $300,000 from $3.4 million to $3.6 million, with both commercial and government parts of our business contributing to the increase. Subscription gross profit margin was 89% for the quarter, up 4 percentage points from Q2 last year. The improvement primarily reflects lower subscription platform costs, which decreased by $300,000 year over year. Service gross profit margin was 60% for the quarter, up 1 percentage point from Q2 last year. The improvement was primarily due to a favorable mix of service revenue. Operating expenses were $16.7 million for the quarter, compared to $13.1 million in Q2 last year. Operating expenses for the quarter included $5.4 million of stock-based compensation expense and $700,000 of severance costs related to our former CEO. Excluding these one-time costs, operating expenses were $10.6 million for the quarter, down $2.5 million or 19% from Q2 last year. The decrease reflects lower other stock-based compensation expenses of $1.4 million and lower cash compensation costs of $1 million. Non-GAAP operating expenses, which exclude non-cash and non-recurring items, were $8.1 million for the quarter, down $800,000 or 9% from $8.9 million in Q2 last year. The decrease primarily reflects lower cash compensation costs and other operating costs, partially offset by severance costs associated with the CEO transition. Net loss per diluted share was 54 cents for the quarter, compared to 38 cents in Q2 last year. Non-GAAP net loss per diluted share was 8 cents for the quarter, compared to 11 cents in Q2 last year. Turning to cash flow, we ended the quarter with $8.8 million in cash and short-term investments and no debt. During the quarter, we used $1.0 free cash flow and $600,000 to repurchase shares associated with our employee equity programs. We also raised $300,000 of cash proceeds on our ATM program at an average price of $12.59 per share. For additional information regarding our financial results and risks and prospects for our business, please refer to our 10-K, which will be filed shortly with the SEC. Max, please open the call up for questions. Thank you.
Thank you. We'll now be conducting a question-and-answer session. If you'd like to ask a question, please press star one on your telephone keypad. Confirmation tone will indicate your line is in the question queue. You may press star two if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Our first question is from Joshua Riley with Needham & Co. Please proceed with your question.
Great. Thanks for taking my questions. In terms of the go-to-market rebuild here, can you just discuss in more detail why retail and CPG are the right industries to be focusing on for sales going forward? And in terms of the org redesign, what are you thinking in terms of the timeline to get all of these senior positions in place and working to execute the strategy as one team?
Yeah, thanks for the question, Joshua. If we take a look at why those two industries, not only is it because those are the two industries that are very well developed already today, and in terms, of solutions that we already provide to those two industries, as well as we believe that's where we have the greatest differentiation in our current product portfolio today. And I tried to provide a little bit of the solution overview in the deck that I provided, earlier that you saw. And if not, you'll have it shortly. So that's kind of just a quick summary where we believe we can build the greatest moat as well, particularly with our retail gift card program, as you're already starting to see the beginnings of that. In terms of the go-to-market team build-out, as you've already seen and have heard, we're moving pretty quickly with that. We've hired a VP of our retail solutions business. We've hired a CRO, and I would expect a couple more hires by the time, at least one or two more hires by the time we get out of, August, September. I would expect that full team build-out, at least at the senior level, to be complete by the time we get out of Q3, and then adding capacity at the account executive level as we progress through Q3 and Q4.
Got it. And then as you think about the restructuring of the business model here to some degree, how are you thinking about the pricing and packaging model and contract structure for customers? And does that need to evolve as well along with the go-to-market strategy, or is it, how are you thinking about that?
It does need to evolve. However, for our retail gift card program, the pricing structure that we have in place for that, as well as the solution packaging, is already very well defined. I'm pleased with what I've seen, and I think that's a program In fact, I'm confident that's a program that we can accelerate very quickly with the pricing and packaging structure we have today. The other areas are going to take a little bit of work, and I'm comfortable that we can get through that very, very quickly. In fact, as I noted, in my narrative, one of the areas that we are reforming the go-to-market teams against is clearly defining the two industries that we're going to market in, as I noted, being CPG and retail, clearly finding the solutions that we solve in those two industries and the value that we create in solving those particular problems in those industries. That's where we're going to get the most amount of stickiness. And so we're going to be matching the solutions that we have today to those problem statements. And that's a very rapid exercise that we're going through now. So that's where the repackaging, if you will be occurring here in the short term.
Got it. And then the commentary implies a greater ramp for gift cards in 2027, if I'm understanding that correctly. How do we think about what's the opportunity through the holiday season here in 26 in terms of revenue that could be coming through in Q3 and Q4 there? And is there any possibility for a bit of upside to the 2026 holiday season on gift cards?
I would not anticipate that there would be, additional that I can commit to at this point for the gift card program through the balance of 2026, while the build out in the partnership structuring has already been completed, as you heard me go through, from the Incom and the Blackhawks on the aggregator side, the Datalogics and the Zebras on the scanner side, and Westrock's on the packaging side. That's a tremendous amount of heavy lifting, and at the same time, we're building a pretty significant moat, that is becoming impenetrable. So that's where a lot of the legroom has been happening. Now, together with those aggregators, the Incom, the Blackhawk, as well as directly to those large retail, partners and customers that we're working with, a lot of that significant demand will be built up through the balance of the second half. And that's why I'm saying we expect the build out to really happen and the demand start to happen towards the end of Q4, beginning of Q1 27.
Got it. That's really helpful. And then just one financial question. As we look at the exit rate of ARR here for Q2, is there any considerations in terms of customer churn that we should be anticipating for the second half of the year? And how do you feel about your current visibility on this base of ARR and potential churn? Thanks, guys.
Yeah, Josh. I think it's important to remember that most of the churn that we've seen over the last 2 years really has come from two customers, and were a result of factors outside of our control. Obviously, every business has some voluntary and involuntary churn, but those two are kind of special cases. And if you look at those two customers combined now, they represent a lot. They represent less than 10% of ending ARR. And why I share that is just our customer concentration in general is significantly less than it was before. So, our focus really is how do we maintain and grow these customer relationships and minimize churn where we can. But if you really are looking at trends, it's really those two customers that account for the majority of the churn that you have seen.
Got it. Super helpful. Thank you, guys.
Thank you, Josh.
Thank you.
Our next question is from Jeff Van Rhee with Craig-Hallum Capital Group. Please proceed with your question.
Hey guys, this is VJ on for Jeff. First kind of question for me. In the last year or so, there's been a little bit of a pivot from capital returns to now a little bit of capital raising. I'm just wondering, how are you guys going to approach capital allocation going forward? Is it going to be trying to get to break even as soon as possible? Is it going to be kind of growth at any cost? What's kind of the thought process there?
All of the above. It's certainly, and as you heard, and I give you an indication of the go-to-market build-out, that we are embarking on. And part of that is to do that in as much of a cost-neutral way as we can. But that's where a big part of the capital raise planning that we're looking at right now is going to go into. This is a build-out of our go-to-market program and teams that we have in place, and that's I'd say where 90% plus of the investment is going to be going into.
Okay. Yeah, that makes sense. And then the two other retailers that are going to be rolling out here in, I think it was August and October, is there any kind of quantification you can do around size or revenue potential for this?
Not at this time, but I would say that a couple of the retailers that we are working with, that we're talking about, a couple of the largest global retailers in the world. So, they can be very significant in size. The rollouts are starting small, but they can ramp very, very quickly and with very significant scale.
Okay, got it. And then just kind of last one from me. How do you think about unit economics for the gift card solutions? I mean, how scalable are these things, and how do the economics change as you kind of get to these fully deployed across hundreds or potentially even thousands of stores?
Yeah, it would be the hundreds of thousands actually, and we've already have quite a good framework in place in terms of unit economics that are really based on volume, number of stores that are already in place with our aggregators, being the Incoms and the Blackhawks, as well as with our retail customers. Of course, there are individual negotiations as we really start to ramp up with some of these large global players, but the framework is already in place, and we believe we can scale that across the board.
Got it. Thank you guys so much for taking the questions.
Thank you.
Once again, if you would like to ask a question, please press star one on your telephone keypad. Our next question is from Jeff Bernstein with Silverburn and Bernstein. Please proceed with your question.
Yeah, I just wanted to hear a little bit more behind the emphasis on the GS1 Digital Link opportunity. And, we've had a fair amount of kind of one-in-a-row contracts in various opportunity sets. Why is this one the one where you see pressure for additional customers to adopt in a timely kind of fashion?
Well, that's one of the many I used as an example of what I call external forcing factors, as well as Sunrise Initiative. And the wonderful thing, when you're in the go-to-market business, there's nothing better than having regulatory external forcing factors to drive the justification for the need. That's just one of the elements that will drive the demand. Of course, a big part of the demand beyond just our digital link solution, and as I noted from the slide deck, enclosed, we have a number of other solutions within CPG, that just being one of them that we've already rolled out successfully to 45,000 SKUs for an extremely large CPG manufacturing distributor. That's one that we know is proven. We've got a reference on it, and we believe we can duplicate. And that's just one of the solution areas across our CPG platform that we believe we can roll out.
Okay, thank you.
Thanks, Jeff.
We have reached the end of the question and answer session. This concludes today's teleconference. You may disconnect your lines at this time.